It is now 8:35, and it's time to bring in JC Parets. He's the founder of Eagle Bay Capital, 10-year veteran and market technician who actively manages money, incorporating technical analysis and behavioral finance into his work. He's worked at CNBC, Fox, Bloomberg, Business News Network, Wall Street Journal, Yahoo Finance. You can find JC in a lot of outlets, but the only place you can find him every Thursday morning at 8:35, maybe 8:36, is on
This
our
is JC.
JC. It's Joel, Dennis, and Brianna. How you doing on this Thursday morning?
I'm doing great, guys. How are you this morning?
We're doing good. We're doing good. Well, JC, I gotta tip my hat to you. You were holding your bear. I know you're holding your bearish long-term stance on things. And last week, I really pressed you, and you said you were bullish. You said you liked what you were seeing on the charts. You identified where you were wrong, which is something we stressed on the show. And you got a bad unemployment number, which turned out to be good for the market. You've had a nice rally here, JC. You're looking for a little bit more on the upside, or you're taking some profits?
No, I think you got to take the profits. A week ago, actually a little bit more. So Tuesday and Wednesday, we really started to see the transition. And then on the radio show last Thursday morning, when you asked, it said you got to be on the long side. I think this counter trend rally is great. In fact, I think you mentioned something about Carl Icahn had put out a warning that the market was going to go down.
Mm-hmm.
And I think that just goes, reiterates the two things. Number one, you can't worry about what other people are doing. I don't care if they're Carl Icahn or Warren Buffett. They don't care what we're doing. Why should we care what they're doing? And number two, everybody's time horizon is different. He has $30 billion or whatever it is. He thinks that the market goes down. I think you guys said, over the next year or so, he saw some issues going on. And, we can't really worry about that. We have to worry about our own personal time horizon. So to me, that it just goes back to, that's just gossip. What people like that are saying about the market. We can't worry about that. We got to focus on price, and price was suggesting that we need to be long, very long. And, I've been bearish since March. So for me to say, get long and buy S&Ps, it was really just a weight of the evidence sort of thing. Russell 2000, micro caps, mid caps, those really had a big spark. And, sure enough, the ones that I liked the most were the commodities, countries with commodity exposure and commodity-based stuff, and those have been the biggest winners. So, but I think you got to fade this. Sure, we might have a little bit more depending on what we're looking at specifically, but all of that overhead supply that broke in August and July, that's just above head. So
still
the
there.
reward isn't what it was last week. I think you got to fade it.
Okay, before we go into individual issues here, when I was reading your bio, it says that you incorporate behavioral finance into your practice. Now I know you like the keys from the cab drivers or the guys on the street or the checkout corner at the grocery store. I mean, did you do any formal studying that? Do you have like favorite indicators, like favorite magazine covers, or how do you actually incorporate behavioral finance into your work?
Sure. Well, anecdotally, stuff like the cab drivers and the barber shops, I mean, that's great and it's fun to talk about, but it's not really anything actionable. That's more from an anecdotal perspective and, stuff to talk about, with beers at a bar with buddies. But, I like to look at the data. I look at a lot of the sentiment data, the Commitment to Traders report. I see it every week. We have an aggregation of multiple sentiment indicators when it comes to Vector Best and Bloomberg and Net Davis, and you bring all of that together. And for me, from a sentiment perspective, it's mostly when it gets to an extreme. Sentiment, 95% of the time, maybe even more than that, is just noise. It's just a waste of time. Sentiment, it really brings value when it's at an extreme, at a historic bearish level, or historic bullish level. So that's really what I look for. When it comes to sentiment, and that's why I'm incorporating behavioral finance. Not to mention that the market is based on supply and demand. If there's more buyers and sellers, it's going higher, and vice versa. I don't really care about why. I'm sure I don't watch TV or really read the news, but I'm sure that people are making up reasons for this rally over the last week, like something with interest rates or China, or I don't even know what. But I'll tell you this right now: on the new lows, on the resets of the lows, earlier last week, we had bullish momentum divergences across the board and Fibonacci extensions getting hit left and right. So the risk reward was skewed to the buy side. Fundamentally, reason-wise, we're not going to waste our time looking for why. That's why for me, from a supply and demand standpoint, that's all that matters. And it's had to get long. So, that's behavioral finance, watching what the buyers and the sellers are doing, not necessarily spending all day looking for why.
JC, so what do we do here now? We've had the pretty impressive run, a nice kickback, a nice bounce rally, and a lot of the dogs like Alcoa is bouncing back nicely, Caterpillars, Deers, all these leaders or all these laggards that just became all of a sudden your leaders here. Is this just a nice bounce here to sell on most of these stocks from a longer term perspective, or is this still the development of a new trend of moving the money from the former leaders into the laggards?
Well, I wouldn't necessarily say that because biotech has been a huge laggard and they've been getting crushed.
Biotech isn't, yeah.
Yeah, so I would say that it's not so much the leaders to the laggards. I think it was more of a commodity-based thing. So, the countries with the commodity exposure, the Brazils, the Latin Americas, the Australians of the world, they are the ones with huge balances, not biotechnology. You have, or healthcare for that matter. You have, like the energies and the materials. You mentioned Alcoa, Caterpillar, right? It's all the same theme. Canadian dollars have been, a big one for me. I love Canadian dollars. I still do, actually. So that whole world, that whole theme is who's benefited. Not so much the leaders and the laggards because biotech didn't bust and they're still a disaster. Now, I do think, getting back to your question, I do think that this is just counter trend in nature. Nothing has changed. On a relative basis, yes, I still like energy. I still like the commodity things, but that's on a relative basis. So if you're shorting S&Ps against your commodity-based longs, I like that. I still do. But on an absolute basis, this is strictly counter-trend in nature, and structurally, I still think we're going lower. All of that overhead supply, if you want to focus on the S&P 500, just to keep it simple, stupid, all of that overhead supply from the support that was broken in August is above head. That hasn't changed. So, when you guys were asking me last week, if this was something that if we were going to get a V bottom and just rip to new all-time highs like we did last October, I said, I give it a 5% chance. I still do. I think there's a slight possibility that happens, but I seriously doubt it. And if it does, it's going to take a long time. So, from an opportunity cost is something important as well. Do you want to be buying and sitting here waiting for a potential breakout in the first quarter next year? Or do you want to be taking advantage of the strength that we saw coming last week and take your profits and run and look elsewhere at some, non-correlated stuff? And I think that the latter is probably the best bet.
JC, we're seeing a lot of action here in the European financials this morning. I don't know if we've talked to you about the European one specifically on the show before, but a lot of these charts, I was just looking at them, kind of look pretty bad, actually. Yeah, Deutsche Bank coming out last night, actually, was approaching. It's bounced back a little bit here this morning, but they were talking about slashing their dividend. Credit Suisse coming out with some bad news this morning, and it's breaking down. It's down over $1 in the pre-market. When I look at these charts, and I look at them on a weekly, like a DB or a Credit Suisse or even a UBS or Barclays, and I look at these things going back to the financial crisis. A lot of these stocks, bounced nicely in 2009, 2010, but they've come back down to levels where they're not even that far off their financial crisis lows. Like, for instance, Credit Suisse during the financial crisis of 2009 got down to $18. Now you're looking at this thing at 25. Deutsche Bank, similar story, got down to $20. Now it's at 28. I mean, when you put it in perspective, it used to be a $140 stock. Is there still problems in the European markets and the financials?
I think so, and yeah, we talked about it. I told you guys I hate them.
He hates them.
I hate them.
Don't sugarcoat it, JC.
Hey, I tell it like it is. You guys know that. I think they're a disaster. I think they're a mess. I think you fade any and all strength. Structurally, they're a disaster. Tactically, I mean, you look at Deutsche Bank. You're trading below a downward sloping 200-day moving average momentum in a bearish range. You look at Credit Suisse, you get a flat 200-day moving average. Structurally, it's a mess. Been going straight down for 5 years. I mean, when you look at, number one, we're not looking to put on longs in the market in general, number one. Number two, when you look at these are some of the worst out there in the world. So, I mean, is this a garbage you want to be buying? Yeah, no, it's not for me. I think you keep fading any and all strength. Best case scenario, just stay the hell away from them. And And those are the European banks that are even worse than here in the United States. Here in the United States are a disaster too. I think you fade any and all strength in financials. You look at XLF. If we get above 24, you got to sell that aggressively. Even the regional banks, you got a flat 200-day moving average, lack of trend at best. That's not anywhere you want to be. You look at the broker dealers. You look at a ticker symbol like IAI. You're below all of that overhead supply. Going back 6 months that broke in August. Yeah, this is a mess. In Europe, it's just even worse.
JC, I got two questions for you here. The first one's coming out of the chat, and I know you're good with this Fibonacci projections. How low do you think the S&P will go here if we take out those flash crash lows? Do you have any projections?
Yeah, under 1,600.
Wow. Okay. All right. My second question
I
here.
mean, I think that that's probably the highest likelihood scenario. I mean, I like I said, you guys know I was bullish last week, and I thought we get a counter trend bounce, and we were fortunate enough to get exactly that. But I think that it's going to, I think this is just counter trend in nature. So if you look at the 38.2% Fibonacci retracement of the entire 2009 to 2015 rally, takes you to exactly the 2007 highs. So
Okay.
that would represent a 25% correction from high to low after a 200% rally over a 6-year period. Is that crazy to think about?
It is. I mean, that you come up with those projections, and I like to follow them. For me, I just kind of go on a day by day basis with the average daily ranges and former support and resist levels. That's why I like to get your take on it. Are you?
Yeah, me too. Me too. That's a bigger picture target that I think we could potentially get down to. But it doesn't mean that we couldn't get long last week, right?
No, exactly.
So
I
think you got to put everything within context and understand your time horizon and keep an open mind. Hey, if we see data that suggests some sideways churning that starts putting in a base, and we could potentially get above all of that former support that broke. Hey, we're probably heading higher, but still, to this point, all signs are pointing that in all likelihood we're going to see some lower lows.
Okay, second question for you here, JC. Crude, long consolidation, very long, over a month long, between 43.5, which was the 50% retracement of the move off the lows from 37.75 to 49 and change. Hung out there forever. Now, you finally broke out of it yesterday, but came back down after the inventory data here. Traded back over 40 cents, kind of the classic pullback, old resistance, new support here. Do you think we got a chance here to climb into the 50 handle in crude for the first time? Boy, I don't know. I think since July.
Yeah, I liked it long against 43.5, right? That was the level that we've been talking about. That was the lower end of this pennant or flag formation, call it whatever you want. It was very clear support. You could be long all day as long as we're above 43.5. And we broke above the downtrend line from the August 31st highs. Broke out nicely earlier this week. And the risk reward was definitely skewed in favor of the bulls. The problem is that overhead supply. You got to be fading the low 50s. So from a risk reward standpoint, you're in no man's land right here. You wanted to own it against 43.5. Here we are above 48. But getting back to Fibonacci, that entire the bottom came. If you take the 161.8% Fibonacci extension of the entire 2010 to 2014, 2015 consolidation, that huge consolidation that took place over a 5-year period that broke down last fall. The 161 extension of that was exactly the August lows to the penny, just under $38. So getting back to Fibonacci, I mean, this stuff works. If you're going to ignore them, I don't know what you're doing. So yeah, I getting back to from a more tactical perspective, yeah, I think you got to fade the low 50s. The risk reward was to get long over the last couple of weeks. It worked out well, but I think you faded. I think this is just, I think there's trouble. I think that there's opportunity cost too. So you have a downward sloping 200-day moving average, momentum still in a bearish range, confirming all of these new lows, even the ones from August. So yeah, you got to fade 53, even if we get up there, if we can even get up there, which I think will be tough. Remember you got all that support from January and March that we're running into. So that's tough for me. I'd be taking profits.
JC, about a minute left here. Let's get your pick of the week here. long or short, you pick it, which way you want to go. But you got one trading setup that you like right now.
I still like Canadian dollars.
So get long the Canadian dollars.
Well, I think you got to get long Canadian dollars a week ago, but I still like them. I still think they go higher. 100%. You got bullish momentum. I mean, go to my blog. Go to allstarcharts.com right now. I laid it out there last week. It's still up there. It's a very, very simple. It's a very simple trade. I like it on multiple time frames. You want to talk about sentiment? Canadian dollars are arguably the most hated today than they've ever been. Meanwhile, the commercial hedgers are buying more Canadian dollars than they ever have before. They have one of their largest net long positions of all time. Canadian dollars are, if you look at USD CAD, right, so which is Canadian dollars as the denominator, USD CAD has rallied all the way up to the entire 2002, 2007 correction in USD CAD. We've corrected exactly 61.8% of that. If you look at USD CAD, I think it's a failed breakout above the 2009 highs. I think if we can get back below the 2009 highs, that will confirm a failed breakout and bearish momentum divergence on the weekly time frame. And on the daily time frame, it was the 161 extension of the spring correction in USD CAD, kissed that and reversed. So all of these Fibonacci levels are clustering together. Bearish momentum divergences across the board on USD CAD. Sentiment says it's a screaming buy. So I think you got to buy. I think you got to buy Canadian dollars, which is why I continue to think that the energies and commodity space, things with commodity exposure are going to outperform on a relative basis. Maybe not do so well on an absolute basis, but relative to S&Ps, I like them. And, long Canadian dollar continues to suggest that. And the risk reward is very simple. No reason to be long if we're below last week's lows in Canadian dollars.
Also,
so the risk reward is very well defined.
Also,
these sentiment unwinds can be very powerful. We can have a long way to go.
Also, getting some headwinds from this rally in oil as well. We've been on the line with J.C. Parets. He's the founder of Eagle Bay Capital, a 10-year veteran, market technician who joins us every Thursday. J.C., I'm going to miss you next Thursday, but Brianna and Dennis will be back next week to come up with some more questions. Thanks for your insight on the markets. We really appreciate it. They'll talk to you next week.
Yep. Thanks a lot for having me, guys. I'll talk to you soon.
Thanks, J.C.